Good evening or afternoon, ladies and gentlemen. Now it's time to talk about short-term funding. And short-term funding I think that it's highly boring. So from the many topics that I have to talk during this semester, yeah, this seems to be boring. So you will see that. But on the other hand, the entire company will depend on it. So it seems to be sometimes highly obvious what we can see here, but you can remember that everything depends on this. So yeah, with this, let's start to talk about this. So short-term funding partially is depending on payment method. So how can we deliver and how can we paid? And and that's why it will be really important because until we are producing and we are doing the production and we are doing the delivery, we are not paid. So we are running from credit. And once we paid, then we are really happy. So that's why we have to say that what kind of methods are available for us. So first method can be prepayment. So first we get paid, then we are doing the shipment. They are doing the delivery. It's like when you are going to a store, you are purchasing, you are giving the money, then you get the product and you can go home. Obviously, you can do it only if you have significant market share and power to force your suppliers to accept this. So obviously this thing is happening when I go to the Tesco. I can't say that, okay, at first I will use this your product uh, for my purposes and later I will pay you. So everybody would look with a strange face on me that why? Because they have this kind of market power. So prepayment can be a highly asymmetric thing. Letter of credit is another. So it means that you are doing the shipment, and once the shipment arrives, then you will be paid by the bank of your client. And then the client will pay the bank. Uh, Actually, it's easier. So you are bringing some containers. Obviously, for the bank, it's good when this collateral, so the shipment, which will be the collateral of the loan, it's marketable enough. So if you are selling coal or phones or something like this, which is in a container, it's a homogeneous goods and easy to sell. Then for the bank, it's a really low risk job to do this because come on, if they are not paid by this company, by the importing company, then they will look for another importing company who will buy this. So it's a nice thing to remove frictions from operations because for our exporting company, what matters to be paid. After you deliver, it doesn't matter that you are paid by a bank, by a company. You are using financial services. Slide draft. You are shipping, you have the document that you shipped, the product, it's stored in a warehouse, you have the document about this, and you get the payment. So at the same time. But until you are not paid, then you get the document that actually this stuff in the warehouse is yours. So if you are not paid until a defined deadline, then you're just looking for another client on this market. So if it's marketable, it's homogeneous enough, then still who cares? Okay, now you have to deal with the frictions. So at least in this case, uh, that was and slide draft. And after time draft, it's actually usually the same or similar to slide draft, but here you will have documents against acceptance. So shipment document, and then you got the payment. Consignment. In this case, you have a warehouse at the disposal of your client. So it means that, for example, you are a supplier of some products for a factory that which makes cars, and you are selling tires to them. So you are putting your shipment into this consignment warehouse, and actually this is part of the factory, and as they need, they are coming in and taking the tires out, putting to the cars, and you are paid only after they were taking the tires out from this warehouse. So until it's not taken out, you are not paid, and until it's not taken out, then actually these tires are yours, obviously. So it provides flexibility for your business partner, because actually they can streamline their operations, and also for you it's also much better, because still it's a buffer zone to have this warehouse at the area of the factory, because you don't have to deliver upon request immediately. uh, so you have to fill just the consignment warehouse, and it will be completely enough. Open account. I think that's the most terrible thing, that you are doing a shipment, and after that, maybe within a month or 3 months, you will be paid. That's the most terrible thing, but can happen with you if you are a supplier. So this can be called as supplier credit also, because you are literally lending to the client, because until you are not paid, then you are just providing short-term loan for them without any kind of interest. Or maybe after some level you can ask for interest payment, but still you are waiting for your money. So you are losing liquidity. So we can see that uh, in this case is also a highly asymmetric case when you are in a really bad shape. Okay, so after that, there are many lists. So first of all, we can say there is accounts receivable management. So it means that you have to deal with trade credits. So how can you deal with expanded sales volumes? How can you deal with retaining existing customers? Also, credit terms should consider sales force. It should deal with adjusting bonuses for costs of credit sales. Yeah. Also, inventory management. The problem is that if it's long, there are variable transits, then it will be difficult. And also lengthy customs procedures can make also a huge mess. So yeah, customs can be nightmare sometimes. Also, production location, inventory control. So if you are selling to overseas location, then you will have higher inventory costs, because you have to keep their bigger or larger amount of storage if work is in progress. Or you have to keep there more finished goods, so actually you need bigger buffer if you are selling stuff overseas. Advance inventory purchases. Then it happens that actually no forward hedges are available. Then in this case you are trying to hedge with the assets, which can be interesting, but actually you can do it. And inventory stockpiling, it can happen also. So if you are expecting that the exchange rate would, for example, depreciate, then you start to import immediately, and you are purchasing more goods from abroad or more inputs than it would be necessary, because you know that it will what will happen with, or your expectations what will happen with the exchange rate. Second concept is working capital. And working capital management is a crucial thing because you have to balance out the short-term liabilities and the short-term assets. So you have to deal with cash management, you have to deal with inventory uh, management, accounts receivable management, trade credit, so on the asset side, and trade credit and bank loans on the liability side. So net working capital means current assets minus non-interest bearing current liabilities. Working capital policy means that how you will finance this. So you can have aggressive funding, which means that actually you are using more short-term liabilities than needed to finance short-term assets. So it means that some part of your long-term assets are also funded from short-term liabilities. You can do it until you have your market power and until market is liquid enough. But if there is a demand shock, then these companies are usually not feeding so well after that. So it can happen that it starts them or to pushes them on deadly spiral towards bankruptcy. Or it can be conservative funding when actually you are funding some part of your short-term assets even from long-term liabilities. In this case, it's rational when long-term funding costs are really low. So nowadays it doesn't matter that, or there are not so many differences. Even you were able to see that it triple B rated corporate bonds, that if you are issuing with 5 year more longer maturity, it doesn't matter. So it doesn't matter to balance out if you have even mediocre credit rating. And that can be conservative when actually you are balanced. And of course, to manage this, you have to focus on cash control, you have to focus on your inventories, and you have to control or focus on collecting your cash income from your clients. So because you know that on asset side there are the clients and there is the cash, and you want to convert as much clients to cash as possible. So AR will be significant in this case. And there is the operating cycle. So average age of inventory means that selling finished good on account minus purchasing raw material on account. Because raw material is necessary as an input and your output should be sold also, but you have to balance them out. That how can you collect it, so the two time periods should be also compatible enough. Average collection period means that collecting accounts receivable and selling finished good on account. So after that we have the cash collection cycle. So in this case it focuses on the length of time between company makes payments to its creditors and when a company receives payments from its customers. So cash inflow minus cash outflow. And of course time requirement. So this is which is crucial when you are planning and you are trying to manage the company. So inventory conversion period plus receivables collection period minus payables deferral period will be your cash conversion cycle. And determining permanent versus seasonal funding needs, it will be always really important because we know that usually in manufacturing sector, pre-Christmas period is a peak, so November, December increases. Also summer can generate similar peaks in demand. So actually it can increase funding needs seasonally. And yeah, Accounts receivable management. So there is 5C for credit. 5Cs. So not just for people of marketing when we can find many cash phrases, but also we can find 5Cs, at least in short-term funding. So there is character, so applicant's record of meeting past obligations. There is capacity, applicant's ability to repay the requested credit. There is capital, applicant's debt relative to equity. There is collateral, so amounts of assets of the applicant, which is available for use in securing the credit. And conditions, current general industry specific economic conditions. And also, you would like to minimize cash holdings. And after that, it's really funny because in 2020, using log boxes can be strange. So wire transfer are obvious choice. So it's, I don't know why the book still emphasizes with this thing, but yeah. So wire transfer is nowadays, I think, a leading way to avoid cash usage. Of course, you need forecasting broad cash inflows, so it's with bank account, not just physical cash, inflows, outflows, and ending cash balances. So this is when simulations can be also really important. And inventory costs can be carrying costs, so storaging, handling cost, insurance, taxes, depreciation, obsolescence. It can be ordering costs, so cost of placing orders, shipping, handling costs, and also running costs, which can related to sales and consumer goodwill and production schedules. At higher speed. Okay, so elements of credit policy. It can be the question, how long to pay? Then what kind of cash discounts can we do here? Either tighter standards, which reduce sales, but also bad clients can be removed. And of course, customer relationship can be really important. So actually, trade credit, I think it's highly obvious, but let's say that it's coming from firm suppliers. So small firms, so when you have asymmetric relationship with your suppliers, then you can do it, but costs can be high. And then short-term financing strategy. So we have to identify the key factors. We have to see that what are the objectives, and we have to describe the available options and to see the costs. So first of all, why it's significant for us from international financial management point of view that we have to differentiate between taking exchange rate risk and also the costs of short-term funding, so interest costs. So which one can be better for us? Well, so practically it means that, okay, until we are not paid by our customer, and we have expenditures in Hungarian forint, euros, and Czech korunas, should we look for the lowest interest rate, or we should take up and take up loan in to cover all expenditures in this interest rate, or should we say that, okay, but I don't want to run a kind of exchange rate risk, so let's say that or currency mismatches, so no currency mismatch because I'm taking up the same amount of loan in Czech koruna, euros, and Hungarian forint. What is the expenditure? And maybe the interest cost will be higher, but who cares? So this will be analyzed during the seminar. And after that we can think about that, oh, there is international Fisher effect, because if there is international Fisher effect, then it doesn't matter, because exchange rate changes and interest rate differentials will be negating each other. So, but if not, then it's necessary to deal with it. And since it was really hard to model exchange rate changes by using international Fisher effect, so you can remember when I used or tried to use uh, Fisher effect based model with vector autoregression to forecast Hungarian forint Czech krona exchange rate. So we can say that there can be a deviation from this. Also, we can say that okay, if political risk is higher, then local financing can be a good thing. Because in this case, each subsidiaries have their own exposures and there will be no mixtures, which can be bad for the company. So at the end of the day, we can meet with two strategies. One tries to minimizing the costs of interest payment, and the other is trying to minimize the risk uh, by avoiding currency mismatch. And actually, after that, we can think about that we are using intercompany loans, we are using local currency loans, or we are going to the euro market, the euro not bond. In this case, it will be uh, the international money market, where we can have short-term funds. So this will be utilized. And in local currency, we can say that, okay, we can use term loans, line of credit, overdraft, revolving credit, which renews once we are repaying some part of it, discounting. We can calculating interest costs. We can calculate effective interest rate, which means that annual interest paid divided by funds received. In some countries, we can issue corporate commercial paper, so which means that it's a short-term bond on discount basis. So when the bond market is stable enough, you can do it, but still you have to pay for ratings and issuance. So if the company is big enough, then you are doing it. And for example, in the US or in Japan, it's highly popular. In Europe, it's mostly done by big companies. And cash management, actually you can centralize this. It can be useful because if you have to pay different currencies, so expenditures are appearing in different currencies, and also uh, you have incomes and also in different currencies, but it's a mixture between the different subsidiaries. If you are centralizing this, then you can allocate it easier, and just the missing part should be acquired from the market. So in this case, you can avoid or minimize your currency exposure as well. Also, there will be collection methods, and how can you collect this, but I don't want to talk about this so much. Netting is similar, that if you have receivables, payables against each other, then only the net amount will be transferred. It's usually happening among banks. But if the company is complex enough, then it can happen on corporate level as well. Excess fund investment. So first of all, you have to see that what are the minimum cash balances, and what is excessive, then you can invest somehow. Just we know the problem is that right now this is not that relevant, because short-term interest in euro, we see that it's zero or negative. In US dollar, it's zero. So keeping cash or keeping invested somewhere, actually there is no significant difference, unfortunately. Tax laws. Oh, we will talk about tax laws later, so I don't want to talk about it right now. And some companies are using cash pools, which means that they are centralizing all cash collection at the headquarters or somewhere with nice tax environment, and then they are doing the billing this way to move the money uh, with this motivation as well. Yeah. Why good bank relations are necessary? I think it's highly obvious because we don't want to pay a lot. Okay, so then let's see all these things in practice during seminar.